If you're invested in the stock market through either ETFs, mutual funds, or individual stocks, you're likely receiving a significant amount of dividends whether you realize it or not. Take, for instance, stocks in the S&P 500, an index of about 500 of the largest companies in the US. More than 70% of those stocks paid dividends last year. If you're exposed to dividend-paying stocks, I'd encourage you to give me 2 minutes of your time so I can give you a technique that may help you reduce taxes on your dividends without reducing your dividends. Depending on the size of your portfolio, this could mean saving thousands of dollars a year without making any significant changes to the risk and reward profile of your portfolio. So what's the technique? Let's put 2 minutes on the clock and dive right in. High level, this technique relies on strategically positioning which investments you hold in your non-retirement accounts versus your retirement accounts. This matters because dividends are taxed differently based on where they land. Dividends received into non-retirement accounts are generally taxed in the year they're received. In contrast, there are zero taxes on dividends when those land in retirement accounts, like 401ks and IRAs. Now, retirement accounts are tax-friendly. We all knew that. So do you still have the opportunity to save more on dividend taxes if you're already using retirement accounts? Absolutely. The opportunity for tax savings comes if you're holding some of the same investments in both your retirement accounts and your non-retirement accounts. I'll illustrate how it works by comparing two different investors. Investor A had $2 million invested in the S&P 500 in 2021, which they had evenly split between their 401k and their taxable brokerage account. That year, Investor A earned about a 27% return from stock price growth and about $24,000 in dividends, with half of those as taxable dividends. Investor B also had $2 million and also wanted to invest in the S&P 500 that year. However, Investor B chose to split their S&P 500 investment into two pieces, half in the S&P 500 Growth Index, which is a proxy for lower dividend stocks in the S&P 500, and half in the S&P 500 Value Index, which is a proxy for higher dividend stocks in the S&P 500. Here's the key part. Investor B allocated the higher dividend half into their tax-protected 401k and the lower dividend half into their taxable brokerage account. What did that change? Well, in 2021, Investor B received about a 27% return from stock price growth and about $24,000 in dividends, just like Investor A. However, Investor B only had $5,000 in taxable dividends since the higher dividend half of the portfolio was shielded in the 401k. That means Investor B reduced taxable dividends by $7,000 without reducing their total dividends or stock price returns. As promised, that's the technique for reducing dividends taxes without reducing dividends in 2 minutes. I hope you found this simplified example helpful for seeing the value of giving more care to deciding where you hold which investments. Of course, this is only a basic example, and past performance doesn't guarantee future results. In my investment advisory firm, Andante Financial, we manage more robust versions of this strategy for clients, with special care given to investment selection, rebalancing, and monitoring. As a final note, if you didn't know about this investing technique before watching the video, consider doing any of the following 3 things. 1, you can hit the like button to let me know if this was helpful. 2, you can hit the subscribe button if you want to see more of this type of content. And 3, you can visit my firm's website at the link in the description below if you want to schedule time with us and learn about the countless ways we help our clients with investing, retirement, and all things personal finance. Until next time, thanks for watching.